Thank you very much for that introduction. So, yes, we're going to be talking about M&A, JVs, and growth and consolidation in the maritime sector. Just before we go there, we'll all do a very brief introduction. I'm Jeffrey Tanner, a partner in the maritime trade and offshore team at Stephenson Harwood. I'm based here in Singapore, have been for the last 11 years, and I think we're well known in the room, but in the maritime trade and offshore space, I think we've got the largest dedicated team in Asia, and we help our clients across the kind of full value chain from financing to transactional to M&A disputes and restructuring. I'll pass over to perhaps Emma to do your own introduction of yourself and your company.
Thank you. So Cetus Maritime is an owner-operator in the dry bulk handy-size space. We have around 50 vessels on the water at any given time, and we have completed 3 consolidations in the last 3 years. I take care of anything finance-related, including all the finance side of M&A transactions.
Hi everyone, I'm Samantha. I'm currently the CFO of BWLPG. I have been in the maritime industry for the past 22 years with Maersk, Larsen, Odfjell, etc. I've been briefly on the onshore infrastructure company, Vopak. So our company, BWLPG, is currently the largest VLGC owner and operator. We're running 51 VLGC vessels, of which 39 that we own. So we have been listed in Oslo Stock Exchange since 2013, and last year, April, we also listed in New York Stock Exchange.
Hi, I'm Georg Whist. I'm the CEO of Gram Car Carriers. We listed the company back in 2022. Built a solid, good business with a very visible backlog, which investors seem to like. And then 1 year ago, MSC Group acquired all the stock of our company, so we're now a private company under the MSC Group umbrella. We are a pure tonnage provider within the car carrier space, operate today 21 vessels. Yeah, that's about it.
So I'm Chris Weyers. I'm a managing director with AMA Capital Partners. AMA is a boutique investment bank based in Stamford, Connecticut that focuses on the marine space. We've been around for almost 40 years, quite active, I'd say across all marine sectors, shipping, offshore, asset heavy. We do, marine service businesses, and we work with marine tech companies. So looking forward to the panel.
Hi everyone, this is Nicos Rescos. I'm the Chief Operating Officer of Dry Bulk Carriers. We are the largest listed dry bulk company in the US. We are the 3rd largest dry bulk company globally with 14.5 million deadweight, 143 ships, and a market cap of 2.3 billion.
Thanks very much for those introductions. Now, just before I start asking questions, just to set the scene, as lawyers, we don't predict the future. We very much, as proactive as we can, try and help our clients achieve their goals. One of the absolute benefits of, and kind of the thing that makes our job very interesting is we get to work with everyone in the value chain. Different corporates, different subsectors. We get to work with the banks and also the funds. So really, if I look back over the last 2 to 3 years in terms of what we've been doing, it really is helping those companies merge, acquire, enter into JV arrangements. We've helped companies with their fleet acquisitions. On the financing side, both borrower and lender side, we've helped on the kind of post-M&A activity where companies try to create value and synergies. So we really get to see the full value chain in terms of expansion. I think we in the room are very familiar with the key drivers, but in short terms, balance sheets, fortress balance sheets, availability of credit and interest not only from established industry players, but interest from outside money, from private equity to institutional investors. So there is a perfect recipe there for expansion, and each one of the panel members here has experienced some expansion in one form or the other. The last point, just to set the scene, is the options available for anyone looking to expand. There are M&A, pure M&A, there are JV opportunities, and we'll delve in later on into some of the drivers behind JV as opposed to M&A. And then there is the pure asset acquisition, so fleet acquisition. And the drivers in each subsector are slightly different, and each one of the panel members has adopted a slightly different strategy for their expansion, and that's what I hope to kind of draw out during the discussion. And one thing I will encourage is, even if I ask a question to one panel member, if anyone else feels that what the other person is saying resonates with them, or if they disagree, then please feel free to jump in and have an open discussion. So the first part I'd like to start us off with is kind of the why. And Chris, I think maybe you can help set the scene on the why. In terms of the conversations you have with your clients, what are those key drivers behind scale? And there are some obvious answers here: economies of scale, costs and revenue synergies. But if you could help the audience kind of delve into some of those in a bit more detail. And more importantly, when you're looking at those opportunities with your clients, what frameworks do you use to evaluate them in terms of both pitfalls and also opportunities?
So I think what drives kind of companies' desire to grow is a little bit dependent on the sector of marine that they're in. But if we start with commodity shipping, which I think is probably the sector people here are most familiar with, the biggest driver of kind of why companies want to grow, particularly the public companies, which is really I guess my focus in this discussion, is they want more scale and they want a larger market cap, particularly a larger float. That creates more trading liquidity and gets more interest from institutional and ultimately retail investors. We've seen a big movement in the U.S. I know it's same with other global markets, that the small and mid-cap companies are out of favor. Like the number of public companies in the U.S. is down, I think, 75% over the last 20 years, and that's why the market cap of U.S. public companies, I think it's probably gone up 6 or 7 times over that period of time. So for marine companies to stay relevant, they've got to get larger and they've got to get liquid and they've got to be more followed. So I'd say that's the number one driver there. If we look at the offshore markets, I think the biggest driver we see there is really synergies. There's the margins in that business historically have been lower, or at least more recently have been lower, and the ability to reduce G&A costs and lower operating costs is really the key driver of M&A in that area. And I'd say if you get outside of shipping, the key driver of M&A generally is synergies more than liquidity. But shipping I think is pretty unique in that size is key, and that's really the driver of growth. And I'd say the biggest thing that stops growth amongst these shipping companies is how they pay for it. So, most shipping companies want to use shares as consideration for growth as opposed to cash. It's very hard to get a share deal done unless both sides agree to do it. A cash deal, is very, it's very easy to convince the board of directors if you pay a premium in cash, it's a good deal for their shareholders and they should move forward. But, if you pay a premium in stock because your shares trade, at a larger premium than, your target, it's a much harder sell to the target board of directors, which I'm sure Nick can talk to because Starbulk's probably been the leader in these share-to-share mergers.
Thank you for that. And then just pivoting, Samantha, to you. Obviously, you've been very busy recently with the acquisition of Advanced Gas, and you, as I understand it, you had acquired them by way of a fleet acquisition. Does any of what Chris has mentioned resonate with you in terms of the frameworks you were looking at? And what led you down the path of the fleet acquisition?
Yeah, absolutely. Chris was spot on. I have never heard such a precise yet overarching sort of summary of all the frameworks across all the industry segments. Thanks for that. And absolutely, from our perspective, we also have our own considerations. First of all, you mentioned the share, which I'm going to touch upon as well. And I mean, we as a public company, since 2013, we have been through quite a couple of acquisitions ourselves, Maersk Tankers, Auroras, etc. But looking at the time of when the Avance Gas fleet acquisition happened, we were at a point of we had an extremely healthy balance sheet. Probably you would say it's a little bit too healthy. Our net leverage ratio was hovering the top, single-digit percentage, low double-digit percentage for consecutively quite several quarters, primarily because that we also have managed to sell off quite some older tonnage prior years and also pay off quite some bank debt through the good cycle. So looking at that, we were in all position to have growth, but for us, very importantly, growth itself is not an objective. It has to serve the purpose to create value for our shareholders, so that we remember very clearly when the management look at this topic. So at the time, if you look at the new building market, even if you look at it right now, VLGC sector, we're a very small one. We are not being prioritized by the shipbuilders. So if you were to order a new building back in that time, you will easily be looking at a new build price of $125 million on an asset. A couple of years ago was at the level of $80 million. And then the delivery day will be end 2027 and or if not 2028. So being in VLGC is a very cyclical yet very short-term market. We have decided to say growth through new building is not going to be the way. But we're small, right? So as a sector, there's not a lot of target you can look at either. But when the Avance Gas fleet become available in the market, it's just a fantastic timing in the sense that we just became listed April last year, and then the deal become surface and into discussion in June. So that's at the time that we have just tested water in New York. Our share price and the liquidity all seen significant improvement. That's why we see that, okay, actually we can structure it in a very mutually beneficial to target and our own shareholders, a very good structure using share combined with cash for such an acquisition. So that's our key consideration at the point in time.
Yeah, thank you for that. I just want to pick up on two phrases that you used. Too healthy in terms you described potentially the balance sheet and value creation. So obviously, at the company level, you're driving things forward, but I presume at the shareholder level, you're also, is that what you're alluding to when you say too healthy? There was pressure to create more value.
Yeah, we all know that debt is to keep the management work hard, right? So you can pay back the debt. You don't just have a day, easy day. So that's what we realized as well, because we don't want it to grow just for the sake of growing, but we also need to make the balance sheet work for our shareholders. Yeah, otherwise it's not economical for them.
Thanks for that clarification. Emma, over to you. Cetus was born out of an amalgamation between AMP and Hamburg Bulk in, I think, 2023. And since then, you've continued the growth trajectory with a number of acquisitions and JVs. On that similar theme of frameworks, could you perhaps talk us through the initial merger, the threats, the opportunities that you considered at that time, and then looking forward into those two acquisitions and ultimately the more recent JV with YZJ?
Sure. So I'll start by saying that each of our transactions were very, very different in terms of scale and complexity, but we approached them in a very similar fashion. So I don't want to use a marriage metaphor when we talk about mergers and acquisitions, but I will. We spent quite some time before entering into any documentation, getting to know each other, really spending time together. That means management teams flying all over the world and really making sure that we shared the same values and the same ethos. Did we have the same risk appetite? Did we face challenges in the same way, or did we see the same opportunities? Moving on from there, we then would spend quite a bit of time on the terms. We think it's important spending that time up front to avoid the risk of a merger or acquisition failing at a later date. So that is deciding who the management team is going to be, what functional areas they will take care of, what the merger ratio, how that will be calculated, what the corporate structure will look like. Will that be tax efficient for all shareholders, old and new? Another commonality, I would say, is that we like to structure all of our transactions using both cash and shares to make it as equity efficient as possible. I think defining terms early and upfront ensures that we're all rowing the boat in the same direction, not only through negotiations, but all the way through amalgamation and integration. So getting clear upfront would be the one piece of advice I would give. Moving on to joint...
Sorry, can I just ask one question on that, on the culture point? Was there already a connection between the two companies? Because you talked about having the right values.
No, there wasn't. We were unknown to each other, having both been Asia-based owner-operators. We were introduced by Transport Capital, who I think we know very well here in Singapore, and it was really them that had identified the kind of commonalities between the two companies. So I will say, in a lot of instances, brokers do play an important relationship in knowing principles inside out, knowing where those value drivers are shared.
Thanks for that.
So moving on to joint ventures. So we closed a joint venture with Yangtze Financial a couple of years ago. They're the listed Singapore arm of Yangtze Shipbuilding. Now, a joint venture obviously has a time and a place as compared to a traditional M&A. I would say it's if you have a specific project in mind that you want to collaborate on, if there is some risk sharing that you want to participate in. So it's obviously less structured than an M&A and less long-lasting. So our joint venture with Yangtze, it had a very specific mandate. It was for the acquisition of 8 handy-sized vessels of a certain age and of a certain size. And what we found was that our joint venture really brought out the strengths in each party. So Cetus, we brought our commercial and technical management, our operating know-how, and Yangtze brought off-market deals that we would not normally have access to, and also a really deep financing network that we wouldn't necessarily have access to. We have found that a joint venture is obviously very quick to execute, and in our case, we executed it quickly in order to access a specific opportunity. In the same vein, they're also easier to exit. Not that I'm saying we do want to exit our JV with Yangtze. Thanks.
Perfect. And now, Nicos, similar question, so I won't repeat it. And, you know, there's other things that have resonated from other members of the panel. Please feel free to join in, and I'm sure there's additional things that you'd like to add. Obviously, we're a primary focus around the merger between Star Bulk and Eagle Bulk.
Thank you. I think the panel has already covered the most significant parts of how do you approach a company and how do you go about issuing shares if you're a public company, or how do you go about making it a value accretive transaction. I think Chris pinpointed very well for a company we've been the consolidators of the dry bulk market for the last 10 years. We've done 9 mergers and fleet acquisitions, primarily fleet acquisitions. Last one was the Eagle merger with 105 ships over those years. Going about using Your share as a currency has been critical for us to issue shares at NAV or at a premium to NAV and using that as part of the transaction. Having an operation that is attractive in terms of fleet profile, cost efficiencies and operations, making attractive for your counterparty to approach you or vice versa and be willing to be part of that organization, it plays a major key. We had to grow. We had to create a company with a larger market cap. We are the most liquid share in the dry bulk space at the moment. In terms of some more specifics on transactions, I think I heard about the culture barrier. This was apparent for us as well with Eagle Bulk, as we did not know intricately the people running the company, and bringing together companies that operate, despite in the same sector, in a very different way was a challenge. But I think we can talk about that later. I think overall this will continue though. We're going to see more people joining forces because there will be major challenges that we will all have to deal with, in dry bulk at least.
Thanks for that, Nicos. Very interesting insight, and we will try and touch upon that later, because I think that's an important part. Once you've gone through an M&A, a JV, you learn a lot of lessons. Those lessons change depending on the fundamentals to that particular transaction and your counterparties, most importantly. But no, certainly we'll turn back to that. Georg, last but not least, and you approach this from a slightly different perspective, perhaps from the other panel members, in that your company was acquired recently by a much larger company, MSC, and that's a very interesting proposition, and we want to explore that. But I guess from your story at Gram Car Carriers, can you tell us about the trajectory from, we had a discussion at the beginning, turning around that company to listing, to getting into a position where you're an attractive target for not only the ultimate acquirer, but more generally in the market?
No, absolutely, and I think again, kudos to Chris here. I think he summed it up well. I think it's a recipe we also follow. You need to ask yourself, why are we listed? Why should we be listed? What is our value proposition? So I think we went quite early and catered to investors, told them what we would do. We told them that we are now going to fix our ships long. We're going to create a very visible, nice cash flow backlog, and we're going to distribute to all. First we started at 50, then we increased to 75% of net profit, and we just kept on doing that, informing investors, delivering on our promise, and as was said here, you need to build turnover in your stock. You need to make sure that people who want to get in and out can get in and out of your stock when they choose to. So we we're reasonably successful with that, I would say. We built, in my opinion, a very solid, transparent, good company. And again, you serve your shareholders, you serve your customers, and you build a great business. And that's what it's all about: creating value, building a great business, and then if the end is that you keep on having great shareholders, which can change over the stock exchange, or you end up someone coming in and say, hey, I quite like this shop, I think it's undervalued, and they buy the whole thing, that's just two different alternatives. We ended up, with MSC saying, we quite like what you created, we make an offer to all the shareholders, and now we're private. So, but again, we just keep on doing what we're doing. You need to build a great business, and you need to create value. We also did M&A in both small fleets, but again, it's got to be accretive, it's got to be a story. We also made a joint venture because we were all about vessels on the water. We were all about paying dividends. We said, well, one time in the future, we might need to renew our fleet, so we created a JV on that, took a small little stake in that company, with the intention maybe to merge it in the future, but maybe not. But again, making sure that what you tell your investors you're doing, you just stick to that and they don't deviate. I think it's super important. If investors want something else, they will buy another stock. So they want, you know, steady dividends and steady course, they buy your stock, and that again drives up the price of your stock, and again creates more appetite and turnover.
Thank you for that. So we've kind of explored the why. So moving on from the why, just looking at the how, the kind of structures, implementation, integration, synergies and drivers. So Samantha, coming back to you, BW LPG is obviously part of a much bigger BW Group family, and generally that wider family has been very active over the last 5 years in acquiring companies, both public and listed, or investing in listed companies. But ultimately, for Advanced Gas, you chose to go down the fleet acquisition route. Now, there are obviously many, many reasons why you would go under that route as opposed to another route, but perhaps you can share some of the kind of main drivers in this instance, why you went down the fleet acquisition route as opposed to another route.
Yeah, absolutely. I think, first of all, is that when it comes to this kind of transaction, is that timing matters and speed matters. I've just mentioned that we just listed, and also especially as a VLGC, we're in a very volatile market. So at the time when we were assessing this particular opportunity, both the physical market as well as the capital market, they were moving. Seize the time and making sure that the desirable pricing as well as the structure is agreed upon is very important. So the timing and speed is very important. And also is that when it comes to vessel transactions, it's a very well-practiced form in the industry, right? You have a very well-formulated process. It's just about repeating the same process of taking over the vessels. So it's something that we can easily execute without any problem. And especially when it comes to corporate deals, Emma also has mentioned, it has to have a multiple strengths come from the targeted company and the acquiring company as well. And I would like to see that Advanced Gas and us, we have a very similar strength, and on top of that, we have a much more well-fledged organizations and a lot of experience in-house, and plus the prior years asset divestment of the older tonnage. We are very ready to take over the fleet. So that's why I think that the asset acquisition was in a way very fitting for this deal. That's why we chose that.
Yeah, so you had the people on the ground that could already optimize the value in that, so that's a big synergy there.
Absolutely. So in a way that by taking over 12 vessels, we only added 2 personnel additional to uplift the new size of fleet. So I think that's
very happy shareholders.
Synergy. Yes, we would like to think so.
Emma, coming back to you, and again, you've kind of articulated the why very clearly, but just looking back on the M&A, the JVs, the acquisitions, can you perhaps share some lessons learned, and besides the culture which you've mentioned, and besides fleet size in and of itself, what are some other successful things? What are some other factors that really make for a successful merger?
I'll be repeating myself somewhat, and it is that spending time to really get to know who you're partnering with, and setting up an organization that is scalable should there be further acquisitions down the line or divestitures. So what we did following the first merger is that we really readied ourselves for the second merger, the third merger, potentially the fourth merger, from a corporate structure perspective. It's 100% leak-proof. It's ready to absorb additional jurisdictions, whether it was South America like Nachipa or Germany like it was with Hamburg Bulk Carriers. We really have a bulletproof corporate structure that we spent a lot of time on. So I would say spending that time up front, working with very strong advisors, including Stephenson Harwood, that we really set our structures up for success for future transactions.
So for the second acquisitions, implementation was quicker?
Much quicker.
Okay, fantastic. Nicos, coming back to you, and this is kind of what you were alluding to before. So moving on from that kind of frameworks and the why, more to the implementation and integration, what have been those challenges over the years that you faced, and what are those success stories? And similar to what Emma was saying, what did you take forward from one transaction into the next to help you conclude it more efficiently, at a better price, or more effectively?
Thank you. First of all, I agree with Emma and Samantha that buying a fleet, which is what a shipping company naturally does while it's on a growth phase, is plain vanilla compared to having to do an M&A deal when you have to mix cultures, personalities, and company ethos and drives that may be totally different once a company comes together with another one. So let's say on the challenging side, first of all, and Chris, of course, was well aware of the Eagle team and what they had achieved to turn around a company that had major issues 10 years ago. They had done a fantastic job to bring it back up to speed and grow the fleet. We had to deal with a very different culture, the operator culture, compared to, although they were ship owners, their background were successful operators running Supramaxes, and for them to understand, being the merged into entity, into Star Bulk, that we prefer to have a more holistic approach of making sure that we are the cheapest operators while managing to trade in the most difficult ports and still trying to get the business on chartering ships. That was a different mix to what they were used to. Integrating, of course, systems between 3 different offices, whether that was Singapore or New York, together with Athens and Denmark. It proved to be a challenge to do it in a manner so that you wouldn't lose too much space with your reporting, your commercial evaluation. It took us a year to bring everything together. I think it was a huge challenge on the Star Bulk organization. However, if we were to repeat an M&A, there are not so many opportunities anymore in the dry bulk public space in New York. But if we were to repeat it, it would be a much simpler exercise. On the fleet acquisition and how do you go about attracting a counterparty, yes, is one, identifying a target. But as I said before, as many of our partners into such fleet acquisitions were actual ship owners who decided, instead of running their own, or at least part of their fleet, they prefer to be part of a larger platform, a very liquid platform to buy and sell shares. I think a lot had to do with them understanding that we operate a very tight operation in dry bulk. So that is still definitely the case. There is still talk of additional acquisitions. I mean, things are a bit more expensive today, but the depth of operation does make a big difference in assessing the vertical operation, how well you have managed it to bring in candidates.
Perfect, thank you for that, Nicos. We're running out of time, but I want to ask the last 2 questions, but we're going to need a rapid answer from both of you. Georg, you didn't chase synergies, but perhaps synergies have landed on you. Can you, very briefly, and perhaps in the next 60 seconds, just talk us through some of those synergies?
No, absolutely. I mean, that's quite important when you do M&A, or for our example, it was being taken private, is that you very quickly go out and identify, do we have synergies? Are there some low-hanging fruit? And I think we did a very swift, quick process. And of course, when you become part of a MSC group, which runs, plus minus 1,000 ships, there are synergies, especially on the cost side. You get a totally different purchasing power, just tapping into those major ones, we did quite quickly. And then also on the technical side, because when you have experience operating 1,000 ships, you see more issues, you are exposed to multiple different technologies, so we could tap into some of that, and instead of test and error ourselves, we could benefit from the scale that they have. So So I said those are the predominant synergies as we see them. It's cost and technology.
Thanks for sharing. And then just the very last question, Chris, to kind of wrap things up. We've been looking back in time, now looking forward in time. Nicos has alluded to the fact that some of the opportunities in the bulk sector now, the low-hanging fruit, have perhaps passed us. But looking forward to the next 12 to 24 months, do you see, given the market fundamentals, more opportunities for consolidation? And where?
So we definitely see more opportunities for consolidation. I know I've heard a lot of panels the last couple days, and I think people have been talking about, M&A activity being generally pretty slow. I would say M&A activity is not that slow. I think it's been, pretty consistent. Like we've seen a lot of deals get done over the last couple years. We talked about, Starbulk Eagle. You've had some big mergers in offshore with Diamond and Noble. We've had some big, private company acquisitions. We've got Hafnia now, looking at Torm. In our kind of domestic market in the U.S., we have a huge amount of consolidation going on in the Jones Act space. So I feel like things are busy. I think the ability to do share mergers, just given the decreasing number of public shipping companies, is there aren't going to be as many as there have been in the past. But I think for companies that are willing to use cash and there's lots of opportunities out there. So I see it staying pretty strong. And synergies really are key, like synergies and cultural fit, as you've heard from everybody here. Synergies alone don't do it.
So we're going to be busy continually moving forward. I think we need to wrap up on time now, but I want to thank each and every one of you. That was a really interesting insights that you've all shared. So thank you very much for taking the time.